Fitzgerald, and I wanted to just do a quick video for you since it is September, Life Insurance Awareness Month. This is the most important month of the year in my business, obviously, because I am a licensed financial professional in the insurance industry. But a lot of people don't understand how to calculate how much insurance they should actually have. In fact, I run into people all the time who say, oh yeah, I'm covered. And when I ask how much coverage do they have, their response is usually it's a group plan from work and it's $50,000. Not quite as much as what you would actually need, but how do you calculate that? How do you know how much you need? It's actually 60% of Americans do not have enough life insurance. So I'm just going to go through this real quick to show you how to calculate your own life insurance need. Okay? So we start off with debt. So we're sitting down with a client, for example, and we ask them how much debt they have. Do they have credit cards, car loans, student loans, anything like that? So I'm just going to put some examples in here and we'll add it up and you'll see what happens. And it's actually sometimes a little surprising how much it actually is. But then I'm going to tell you about the cost of such life insurance as well so that it's not so scary. Okay? So as an example, say we've got an average American, maybe they have $10,000 in debt, which is actually low, unfortunately. And their income, say we have the main income earner in the household here in Lee County might be earning $70,000, and I'll show you what to do with that in a second. And maybe they have a mortgage on their house still, and they have about $150,000 left to pay on the mortgage. When it comes to the education line, this is where we have to start talking about, okay, so how old are your children? How many do you have? And, what kind of college education would you like to arrange for? Unfortunately, we have a staggering college tuition debt in America. It's over $1.4 trillion currently, and that's not just the kids taking that on. Sometimes it's the parents and sometimes it's grandparents, unfortunately, who are living in a fixed income situation on Social Security and such, and they're paying for college loans for family members as well. So as an example, let's say you've got a household that has two children. One of them's 3 years old and one of them's 7 years old. I will ask the parents, say, do you want to, say we're talking to a husband and wife, just as an example, okay? You can use this any scenario. So you're talking to the husband and say, if you were not to come home tonight, if you were to pass away, would you want your wife to have to immediately move out of the house? And would you want her to not be able to stay at home with your 3-year-old, instead put your 3-year-old in someone else's care, and for her to have to go secure an income to be able to put food on the table properly for your children? And do you want your children to go to school, to go to college, and do you want them to have to pay that debt, or would you like to be able to cover that for them? Now sometimes, if you've got two parents who went to college, typically their children are going to go to college, and so they're going to be like, absolutely. Sometimes you have two parents who did not go to college, but they aspire for their children to go to college. And I think most parents in general do not want their children to go into the world having massive amounts of debt upon them the day they step out into reality, right? So we ask, and so I kind of figure out if you can judge your children, because there's 3 levels of college. So there's community college, which you might want to put away around $25,000, $30,000 for something like that. And there's state-run colleges that you can probably get for $30,000 to $100,000, depending on what degree they're seeking. And then there's Ivy League. So those are, you're talking, $100,000+ in that range. And you can kind of judge your children, I think. Personally, I don't know about every parent, but I know that I look at my own son and feel that if he goes to college, it would probably be community college or state run. I don't think he's going to be Ivy League. He's not going to be a doctor or anything like that to require that high of a level of education. So for me, I would put in around $50,000 for my son's education. So in our example here, say one of the children is going to go to a community college and the other one is going to be a state-run college. So let's put away, say about 80,000 for education in here. Now, let's go back to the income though real quick, because say you do have a 3-year-old in the house. Do you want your spouse to have to go get a job before the children are 18? Or would you like to provide that income replacement for until your children get to the age of 18? That's typically what I calculate. So normally on a base, we calculate it times 10. But if you got a 3-year-old in the house, you got to multiply that by 15, not just 10, because it's 15 more years before they are actually 18, right? So if we multiply that income by 15, you're actually at 1,050,000. So that's a pretty significant chunk of change, right? And if you add these all up, sorry, I should have did the calculation firsthand, but that's okay, right? We add that up, you're at 1.29 in income, in insurable need for, say, the father. Now, we were talking about this wife as if she were a stay-at-home mom, right? And sometimes the other person is like, well, I don't need as much income. You're still going to cover that debt for this person because they're going to incur your debt, whether it's yours or theirs. It's still there, right? And you look at the income and you say, well, that's no different. But wouldn't it be nice if you didn't have to worry about the mortgage and you still want to put your kids through college, right? Now, the calculation obviously looks like it's a lot lower, right? 240,000, but there's no income here. And I emphasize this part for a stay-at-home parent, that there needs to be income there. Because if that parent doesn't come home, how much is it going to cost you to replace the activities that that person does? They clean your house, usually. They cook. They pick up the kids after school. They, whatever their activities are throughout the day, there's a monetary value to that. And it typically is between $2,000 to $5,000 a month if you were to, because now you're going to definitely have to stay working all the time. You can't take time off because you've got to provide that income, right? So I would typically say somewhere between $2,000 and $5,000. Kind of depends on what that person does. Like I said. So let's just do a lowball figure of $3,000 per month. So you're still talking a $3,600, $36,000 a year in income replacement, and then you have to multiply that by that 15 years in order to make sure that that income replacement, basically, or activities replacement, is being covered until your 3-year-old is 18. So now we're at $780,000 for the stay-at-home parent and $1.2 million for the income-earning parent. So you can, and that's a really easy, we call it the DIME method, D-I-M-E, is debt, income, mortgage, and education. You can easily sit down and calculate this out by yourself. Like I said, just calculating how many years of income replacement you want to provide for your spouse. Because life insurance really is about that. It's about taking care of your family after you're gone, right? You love your family. You want to provide for them. You want to make sure that they have the best life possible. And unfortunately, accidents do happen, The statistics on heart attacks and strokes and car accidents are staggering, and there are way too many people out there who are using GoFundMe to pay for the funeral, which actually I forgot to add in here, but that could be anywhere from $5,000 to, well, you can get as low as $1,000 here in Lee County for a cremation. But that's still $1,000, keep that in mind, right? And casket burials start around $12,000 here locally, and it varies from city to city, state to state across the nation. So make sure you look into that as well, because that actually needs to be part of the calculation too. Now, I said I'm going to talk about the costs of insurance, right? And so I'm actually going to give you some hard and fast numbers. I have a couple of different policies personally. So one of my policies is $250,000, and I pay $17 a month. Now that it usually is really shocking to people. And that's a nice chunk of coverage right there, $250,000 in coverage and $17 a month. That's like how much it costs to insure 2 cell phones today, right? And if our cell phone breaks, we don't get $250,000. In fact, they usually make us pay a deductible to get a new cell phone, right? Even though you've been paying that insurance. And I think people are scared of the expense of life insurance because they think about like their car insurance, where you're paying, anywhere from $80 to $150 a month. And if you have an accident, you might get, $20,000, $30,000 out of that. So it's not as good of an exchange, obviously, right? I have another policy that's $150,000 in coverage, but that one's a permanent investment grade life insurance. So it has multiple things that it does. It not only will provide that benefit to my son if I pass away, but it will also is allowing me to accrue a retirement income. Now I can invest anywhere between $200 and $400 a month in that, and it's very flexible premium, but it's a very unique kind of situation. But again, at minimum $200 a month to provide for my son $150,000 worth of coverage if something were to happen to me. That one also has long-term care on it. So if I were to have any long-term care needs, for instance, having a car accident and being in the hospital for 6 months, that would put food on the table. So make sure you sit down with a licensed financial professional who can provide insurance needs for you and your family. This is super important. There are way too many people out there using GoFundMe, like I said, just to cover the funeral. And that doesn't help the family with everything else. Putting food on the table, making sure that your spouse and your children don't have to sell your home 10 days after you pass away because there's no way that they can afford to pay the mortgage without your income. It's super important. Life insurance is not for you. It's for those that you leave behind, to let them know that you truly care, that you love them, and that you're going to take care of them no matter what. If you have any questions, feel free to reach out to me. Make sure whoever you sit down with has the ability to look at multiple companies, right? Make sure that they're not captive to just one company's products and services, because there are literally hundreds of options out there, and you really should be sitting with someone who can show you options, because every single person's situation is different. Hope this helps. Go calculate what your insurable need is and see if you have the proper amount. It's Life Insurance Awareness Month. If you don't have the right amount, please go get some. Have a great day. Jennifer Fitzgerald signing off here.